welcome to accounting. And the best part is it's the second to the last night. 2 more classes. That's good for you, it's good for me. So I thought what we would do is talk for a second about the administration for what's going on. So we have 1 more class. What do we expect to do in today's class? Today's class, my expectation is that I'm going to move on with the notes. So we've done chapter 32 to some extent, and we want to go back and clean up chapter 31, go on to chapter 33, and get as far as we can go today in class. Now, what does that leave for next time? Next time, I want to remind you that we're going to do 1 case and 1 case only. We had talked about maybe doing 2 cases, and we just are not going to have enough time. So the 1 case that we're going to talk about in class next week is Camelback Communications. And that's a case that's in your packet. And I want to remind you that case is, in a sense, a teaser or a preliminary for the case that you can do as extra credit. And the extra credit case is Destin Brass. And the Destin Brass case is due either Wednesday or Thursday, April 25th, 26th, somewhere in there. But we definitely want the extra credit in long before you take the final exam. Because in theory, that should help you study for the final exam. Which is, now when's the final exam again? Monday, April 30th. Right? So, we have 2 weeks from tonight, basically. So now's a good time to start studying. Just foiling suggestion. What's the final exam going to look like? And the answer is it's going to look very similar to the midterm. There's going to be 10 questions, just like the midterm. And you'll have the full 3 hours to do all 10 questions. Now, I guarantee there's going to be 1 question which is a cash flow statement, similar to what we did in class. I guarantee there's going to be 1 question which is a bond question. Right? Has to happen. Going to get a bond question. Now, let's talk for a second about just the course in general. In financial accounting, and this relates to the exam, just so you understand where I'm coming from, in the financial accounting portion, what I suggested to you was that there are 2 points I think are extremely important. If you only bring 2 things away from this class, from financial accounting, what are those 2 things?
Net present value.
Okay, the first is present value analysis, or net present value is part of that. And the other is cash flow. So what does that then suggest with respect to the final? What kinds of questions are you going to get on the final? You're going to get questions that deal with present values, like what? Like bonds. You're going to get questions that deal with cash flow, like what? Like a cash flow statement. Now, is that the only cash flow kind of question that we do? And the answer is no. All the questions about royalties payable is a cash flow question. The questions about again, from the midterm exam, the questions where you go from a cash basis to accrual basis is a cash flow kind of question. You have to understand how cash moves. So if you go back and think about the questions on the midterm, most of those questions involved it was necessary on your part to understand how cash moved, how cash affected the transaction. And you're going to see more of that. Right? Same kinds of questions, but more of that. Okay. Now, managerial, which is what we really only have 3 classes to do. What are the things in managerial that I think are so important? Well, item number 1, first and foremost, is how much does it cost? We're going to see today that we will do a lot of work in how much does it cost. Now, as we spoke last time, the key to understanding how much it costs is that we separate costs into 2 broad categories. What are those 2 categories?
Fixed and variable.
Fixed and variable. So we have fixed costs. Now, in accounting, we call the economic term is fixed cost. The accounting term is what?
Overhead.
Overhead. Right? And direct cost, variable cost, same thing there. Right? Now, what's the issue? Right? And the big issue in terms of how much does it cost is how do you allocate fixed costs, or how do you allocate overhead? It turns out to be a huge issue because it turns out that sooner or later it becomes a random process, unlinked to production. It's very difficult to discern a link between the fixed cost and the actual units being produced. Most firms do a pretty good job of calculating and taking account of the direct costs. The direct costs include what? Direct materials, direct labor, things like that, right? Overhead includes what? It includes the lease of the building. It includes depreciation on equipment. It includes, things that are communal in nature. So one way to think about this is these are communal. They're almost always communal kinds of costs. They cannot be identified specifically to one product. Many products make use of the building, or the lighting, or the maintenance department, or things like that. Okay, so that's one notion of cost, which will be primarily what we cover in the next two classes. However, another issue that's very important, in my opinion, is one of incentive structures. And in particular, the question is, what does that particular accounting policy, what does that incentive structure suggest should happen relative to the people who are working under it? Now, let me give you a couple very quick examples of what I mean by that. So, suppose Dave and I are going out to dinner. Okay? Now, since we know we're going to be going out to dinner, we have two ways to decide about how to calculate who pays what, right? One way is Dave keeps track of everything Dave purchased. I keep track of everything I ate and purchased, and I pay for my goods. Dave pays for his goods, and that's how we split the bill, right? Now, here's the question. Suppose instead of that, Dave and I just said, okay, we'll just get whatever we want and we'll split it down the center. Here's my question. Will Dave take different actions under the first accounting regime compared to the second accounting regime? And I'm willing to argue, right, that if you keep track of all your own expenses, you're going to keep them fairly low. But if you are just ordering things, cutting it down the middle, your incentive is going to be to order a bigger meal, a better meal, a more expensive meal, right? So what's going on here is the accounting system changed the actions of the participants in this little game. Does that make sense? Now remember, what's accounting supposed to do? Accounting is supposed to record what these people did and not direct them to how they should take action. But accounting systems can in fact have a direct effect on the actions of participants in any organization, in any situation. And the key thing is to understand what is the incentive for doing that. Again, does that make sense at some basic level? Example number 2. I was working at a firm, and what the firm did was how they paid their salespeople, right? That's the issue here. And what would happen is they would pay their salespeople some percent of sales. We'll talk more about that later. But what this company would do is you'd get some percent of sales, but you wouldn't get your portion of it until what happened? Until the dollars actually came in. Does that make sense, everybody? Now, in the past year and a half, this company changed to a brand new, very complicated system put in by Bond. But it turns out that the Bond system had a difficult time, which absolutely mystifies me, but it had a difficult time determining when the cash actually came in. And so what this company did was they said, okay, usually what happens, the cash comes in about 60 days. So the company said, okay, since our brand new system doesn't track that very well, we'll just pay our salespeople 60 days after they make the sale. Now, 1 year later, what did they find? What did they find, Delcy?
Salespeople weren't following up on their account.
They found that salespeople were not trying to get the cash to come in, which caused what?
Was that a cash flow problem?
A cash flow problem. Why?
Accounts receivable rose.
Accounts receivable did what? Started to skyrocket, right? So the incentive structure suddenly was such that as soon as these salesmen didn't have to worry about the cash when the cash came in, they stopped bugging their customers to get the cash in the door. When they stopped bugging their customers, all of a sudden the cash wasn't coming in the door, and the accounts receivable started to balloon, and the company, of course, didn't know why. And so they went in and started to analyze what went on. Again, the accounting system in this particular case engendered an activity. The old accounting system, you didn't get your pay until, you didn't get your commission until the cash came in. So the salespeople were always on top of their customers, making sure they paid in a reasonable amount of time, which in this case is 30 to 60 days. But as soon as they didn't have to worry about that, some of these past due accounts were over a year old. Because the salesperson, it wasn't part of their job. And they didn't care, and it kind of fell through the cracks. Does that make sense, everybody? Again...
What was the incentive to go into the bond? Which would be a plus to that?
Oh, the bond system did a whole lot of other great things. Right? I mean, it did ERP, it did, you know, it let them track a lot more information in their organization, which was a good thing. However, you know, not everything about it was good. And so here was one situation where they suddenly developed a problem because of the bond system. I mean, a solvable problem, but, you know, until they figured out what was going on, they couldn't solve it. Questions about that?
I have a question about allocating costs, fixed costs.
Certainly.
When the company rolls up everything, in the end, does it matter to the bottom line how you divvy it up, or is it all just cost anyway? And if you're looking at your overall numbers for the year, then it's just a cost.
Okay. So does everyone hear that question? And the question is, if we have a certain amount of fixed cost, does it really matter how we allocate those costs between our products? Does that really matter? Because in the end, the fixed cost is the fixed cost, right?
And there's added part to that is it could help you figure out what your real price is, but then the market determines the price anyway. So even if you know how much it really costs you, then you still can't really use that all that much because the market's going to determine what your selling price is.
Okay, so the first issue you need to think about in terms of this particular example is, at what price are you willing to enter the market? In other words, should you or should you not be in the market becomes one of the questions. And if you do not have a good way to allocate those fixed costs between the 10, 20, or 100 different products, then you do not know what it costs you to build that item. In other words, you may have a very efficient production system or a very inefficient production system. So, you know, I mean, in my opinion, it makes sense to do a good job of figuring out ways to allocate fixed costs, mostly for pricing issues. Now, your original question, does it affect, in the end, does it affect net income? And the answer primarily is no. Fixed costs are fixed costs, whether we lump them here, there, and there, or lump them all together. Net income is net income because the cost hasn't changed. Now, having said that, here's the next step. That in the last 20 years or so, we've developed ways of analyzing fixed costs. And one way we're going to talk about either later today or next time is something called activity-based costing, or ABC. Activity-based costing. But what drives activity-based costing is something called activity-based management. And the key to activity-based management, in a very simplistic sense, is to look at all these activities and then separate these activities into those that create value and those that have no value. Now once you do that, once you do this analysis, what do you try to do? Now the key to understand here is what? That it's activities that create cost. Right? It's activities. It's when a person picks something up and moves it, that creates cost. Right? Because it takes time, labor time to do that. So the key to understanding cost becomes understanding activities. But then these activities, some of these activities create value, others do not create value. So the goal of management, activity-based management, is to do what? Is to eliminate as many activities as you can that do not add value, either by reorganizing or by changing the way the production line runs, things like that. So so your question, Lamy, is a good question, right? But it's very complex because if we do this activity-based costing well, then what can happen is it can change the activities that we do, which in the end can cause fixed costs to do what? Actually come down. However, similar to what you're suggesting, if we go from just a regular standard cost to activity-based costing, does that mean costs will come down? And the answer is no. No, it's only through the management or through the information that we collect that helps us change the way we produce, change the way we ship, change the size of the run, things like that. So does that help? Okay. Now, next, I want to do a little bit of current events because today is always a happy day in my life. And y'all know what that means, right? All my tax returns are out the door. All my clients hate me because they're paying more taxes than they thought. But at least it's over. Now, what I have is today's Wall Street Journal. And today being April 16th. And I want to talk for a second about the lead article. And the lead article is Capital Gains Tax Cut Picks Up Momentum from Unlikely Alliance. Now, let's talk about capital gains taxes, first of all. What are capital gains taxes? Let's take the example of owning some common stock. Now you're gonna hate me, guys, because I'm gonna come back to the past. So you're gonna have to refocus. Sorry about that. So, if you own common stocks, how do you get a return from owning a common stock? There's two ways. What are they? Dividends. And what? Stock price appreciation. Now, if you get a dividend, how is that taxed?
Capital gain.
Wrong. So you get a dividend, how is that taxed?
Ordinary income.
Ordinary income. Now, what are ordinary income tax rates? At the margin, because dividends, you think of it as coming in at the end, right? It's the appropriate way to think about this, right? At the margin, ordinary income tax rates are what?
Highest.
32, maybe 36, as high as 39, as high as 39.6%, which is for ordinary income, for labor income, for things like that. However, if you buy and sell assets, that's called a capital gain. Or capital loss, right? But in any case, if you received more than the original cost, it's a capital gain. How is that taxed?
28%.
Not the individual. It's taxed at 20%. So you get a significant, in other words, if you can shift getting income as a form of capital gain rather than as ordinary income, you can dramatically reduce the amount of taxes that you pay. Does that make sense? Now here's the question. from this original analysis, again, we want to talk more about taxing and what taxes are and how they affect things. But let's talk for a second about dividends. Now, why would any firm pay dividends? Becomes the next question. Are dividends an efficient way for their stockholders to receive cash from the company? Does that question make sense? And the answer is, what's that?
Some people just want them.
Some people want them. But from a firm perspective, does it make sense? For instance, does Microsoft pay dividends? The answer is no. Right? Many firms do pay dividends. But from a tax perspective, does it make sense to pay dividends? And the answer is,
no.
Your stockholders would be better off by simply selling a few shares of stock when they need the cash, and then getting a capital gain, which is taxed at 20%, rather than regularly receiving dividends taxed at ordinary tax rates, as high as 35 to 39, almost 40%. Does that make sense to everybody? Okay.
You only pay on capital gains if you sell the stocks that you own? Is that how that works?
You only pay if you sell. Most taxpayers are cash basis. They have to actually receive the cash in order to have a recognizable event in terms of taxes.
And they look at how much you paid for it, even if it was like 40, 50 years ago?
That's right. Whatever it costs. Right? You compare the cost to what you sold it for. And the difference is the capital gain or loss. Now, here's something that not many people know about capital gains. And that is, our tax system has rates at 15%, then it goes to 28%, then it goes to 32%, and up to 39%. So here's the question. Suppose you are in the 15% tax bracket, and you get a capital gain. Now, if your ordinary income tax rate is 15%, are you then forced to pay 20% in capital gains tax? Does that make sense? Does the question make sense? And the answer is no. If you are in the 15% tax bracket, then the capital gains tax rate is below the 15% rate and sits at 10%. Now that's kind of interesting, right? I had a client once who had, hundreds of thousands of shares of stock in lieu of a pension. And so what we arranged with this guy was that rather than, it didn't make sense for this guy to go out and take a pension payment because it would put him into the 28% tax bracket. If he kept his ordinary income very low, he was in the 15% tax bracket, then he could sell off 1,000 shares of stock every year, right, at $100 a share, right, collect $100,000 in cash, and pay 10% in taxes. Cool game.
Yeah.
Right? But you don't get to play those games unless you understand how the tax system works, which I think is a very important part of an accounting course, because everybody pays taxes. Almost. Unfortunately, I pay taxes, which always irritates me. Okay. Here is another little tax ditty that I think is important for you to recognize. And that is, suppose you buy a mutual fund. Chelsea?
Did you say on that 15% income level that 10% rate on capital gain, how is that determined?
Well, if you are in the 15% tax bracket, if your income is if your ordinary income is sufficiently small that you're only paying in the 15% tax bracket, right? Then the capital gain, which is supposed to be below ordinary income rates to give you the incentive to buy and hold stock, right, gets taxed at a lower. The gains get taxed at a lower rate, and that rate's 10%.
That's determined by the government?
It's also determined by it's determined by the Senate, implemented through the IRS. Right? Mm-hmm. Okay. Now, here's the next thing that I think is important for anyone to understand, because what I suggest for most of my clients is one of two things. One is to buy and hold individual stocks. This is a fairly risky maneuver. The second thing is to buy mutual funds. Let's say aggressive mutual funds. Now, here's one of the laments that everyone has this year. And what's that lament? If you held mutual funds in the year 2000, what's your lament right now?
You didn't sell some.
No, let's say you held them through. Right? I don't have not having sold them through, to be honest. But the lament is that what the manager of the fund does in terms of buying and selling stocks basically gets accrued to you. So, for instance, suppose that the manager of the fund sold a bunch of stocks that they purchased 25 years ago. And what they would do is they would then earn a huge capital gain. GAIN.
Is this the double whammy thing they've been talking about lately?
Well, okay, I don't know. I don't know what you're talking about. Now, so they have this capital gain, which is the fund. Then that gets distributed as a capital gain to all the mutual fund holders. Does that make sense to everybody? Now let's take a quick example. Let's say we bought the shares of stock initially for $20. Right, just a big number. Now, during the year, this first year, the firm then has it issues to the owners of these mutual funds a capital gain, and the capital gain is say $3 per share. Okay, everyone with me?
What does issue a capital gain mean? They take
Well,
from you?
what they do is they sold common stock. The mutual fund then had a capital gain. That capital gain passes through to you who own shares in the mutual fund organization.
As a decrease in total value.
No.
The tax.
Well, so again, we haven't talked about what's happening to stock. All we're talking about is that when that fund manager buys or sells these stocks, they record a capital gain. That capital gain gets passed through to the mutual fund holders. Right? Does that make sense? So this $3 then gets, in essence, billed to, for tax purposes, the owner of this original $20 share of stock. Now, what happened this year was these prices, right? Originally, one share went for $20, but because all stocks sunk precipitously, the price of the mutual fund may have gone to, say, $9. So what happened was you're holding a mutual fund and had a precipitous drop in value. At the same time, you're recognizing what? A capital gain. And that, I assume, is the double whammy that you were talking about, right? Now, here's the interesting question. Suppose, right? Suppose the beginning of the next year, the price stays at $9, and the person who originally bought that share for $20 sells that share in the market and gets $9. What's my question?
Do they get a capital loss?
What's the capital gain or loss on that transaction? Does that make sense? Now, so what's the capital gain or loss on that transaction? They originally bought it for $20, they sold it for $9, therefore what's the loss?
11.
Wrong.
11 plus the tax on the 3.
Because what happens is you adjust the basis for any capital gains that you receive. So what happens is the original $20 that you purchased it for, plus the $3 in essence that you received in the 1 year as a capital gain, the new basis is $23. That's the new cost to you in essence, because you've already paid tax on that $3. Right? Now what happens is you sell for $9 and your loss is $14. Does that make sense to everybody? So the moral to the story is what?
Don't buy mutual
Don't sell.
Hello? Is anybody out there? What's the moral to the story?
He shouldn't have sold his mutual funds?
No. The moral to the story is what? make sure you keep track of every year's capital gain. Because what could happen is it could start at 20, right? And then you get 3 plus 5 plus 6 plus 2, right? Your new basis is then what? 8, 10, 16, 36. Right? If I added right. 8 and 8 is 16, okay. Right? Now suppose that stock that you originally bought, that mutual fund you originally bought for 20, suppose you then sell it for 30. That's the price in period end. Now, what's the gain or the loss in this transaction? If you didn't keep track of all these gains along the way, what do? You go back and say, oh, I bought it for 20. I just sold it for 30, therefore I have what? A $10 gain. When in reality, what do you have? A $6 loss. Again, does that make sense? That's pretty important. I mean, a lot. Now, most good mutual funds keep track of this for you, and so this doesn't become a problem. But as a tax accountant, and I've done enough of that in the past, you have to make sure that in fact these things were tracked accurately, or at least reasonably, because this gets very complicated very quickly. Okay.
If you have a mutual fund and a Roth IRA, does capital gains matter as much?
Okay, so here's the question: if you have a Roth IRA, does the capital gain matter? Or put differently, what's your strategy for a Roth IRA compared to having stuff outside of your Roth account? Suppose you have an investment account in your name that's not a Roth IRA and a separate Roth IRA. Now the question becomes, what do you put in your Roth IRA and what do you put in your regular account? Again, we're similar. Does this last question make sense? So what do you put in your Roth IRA?
After-tax money.
No, okay. You put after-tax money into it, but then what do you invest that money in?
Things that pay out high dividends.
If you want to have something that pays out high dividends, you buy it through your Roth IRA. Why? What's the tax rate on the Roth IRA? 0. Now what do you put into your ordinary portfolio?
Ones that don't pay dividends.
You buy stocks that don't pay dividends, hence you're going to recognize all the gain as capital gains, and you're going to pay as small tax on the taxable ones as you can. You'll put your either bonds, the interest is all taxable income, right? Or your capital gain, or your dividend paying shares in the Roth, and your capital gains shares in your regular portfolio. Did I answer?
I think so.
What I thought was your question?
Yes.
Okay. Now, in theory, that makes some sense. It turns out that in practice, that it may or may not make sense because of what? Because it may not make sense to buy stocks to pay dividends in the end. And just so you understand, that because of the tax efficiency, since you pay relatively more on dividends, the analysis that has been done, with the exception of the last year or two, which of course tilts it one way or another, suggests that stocks that don't pay dividends give you a higher long-run return, and therefore buying stocks that pay dividends gives you a lower long-run return. Hence, buy only stocks that pay very little in dividends. Now, again, these are analyses that were, before the current fall in stock prices. Okay, here's another one. Again, understanding taxes, I think, is very important, and it's very intuitive for the most part, but you have to sit back and think. Suppose you are thinking about buying a bond, and you're going to buy a bond, and you're going to buy either a muni or a corporate bond. Now, what's the difference between a municipal bond and a corporate bond?
Is that of a state or is it
Tax.
First of all, a municipality is what?
government?
It's the bonds from New York City, or the bonds from someplace in Pennsylvania, or whatever, right? But it's a government-related or public entity, as opposed to a private entity. And so a corporation is DuPont, GM, something like that. Now, how are municipals different from corporate bonds? Munis are federal tax-free. Why is that?
So people invest in local government.
Nope.
Because they're lower yields.
Well, they're lower yield because they're tax-free. Okay? But why are they tax-free? It goes back to the separation of power between states and the federal government. Our very bright forefathers reasoned that they wanted to make sure the federal government didn't become a dictatorship. And so they gave rights to the states that were, in a sense, inalienable. Now, one of those rights is that the state cannot be taxed by whom? By the federal government, right? So states cannot be taxed by the federal government. And the ruling in the Supreme Court was that the bonds for the government cannot be taxed at the federal level either because of the separation between, taxing the bonds from the municipality would be the same in the court's perspective as taxing the state or the municipality. And so these things then became tax-free. Now, suppose the corporate tax rate is 10%. The tax rate is 30%. Excuse me, what did I say? The corporate rate of return, the interest rate in the market is 10%. The tax rate is 30%. Therefore, what is going to be the municipal bond rate for a similar bond of similar duration and similar risk characteristics? What do you think?
12.
This isn't working. And I thought this was so logical. 7. Why 7?
Subtract out the taxes from the corporate bond.
Okay, so the corporate bond would have a 10% initial rate of return, less taxes at 30%, which is 3%, or a 7% after-tax return, right? Now that 7% after-tax return would then be roughly the same for the municipal bond, because the municipal bond is already an after-tax return, right? Again, assuming that they have similar maturities and similar risk characteristics and similar blah, blah, blah. These two bonds are similar, then you'd expect this kind of relationship to hold. So the tax effect on municipals is a strong one, and so it depends upon what tax rate you're in. Now, who should buy munis and who should stay in corporate bonds?
Can you go over how you got this 3?
30% of 10 is how much? 3%, right? The tax rate is 30%.
People who have high tax rates should buy municipals.
Yeah. People who have very, very high tax rates benefit more from the tax-free effect. People who have very low tax rates benefit more from the higher return and lower taxes. Does that make sense to everybody? Again, simple tax planning kinds of issues, but I think not too intuitive if you've never had to think about it.
If they have tougher returns after taxes, what would the difference be? Would it be closer to people who are like borderline on the margin, like getting bumped into a next tax bracket?
Well, so the whole point is that if they have similar risk characteristics, the market should equilibrate them down to the same rate of return after taxes. Every bond has different risk characteristics, therefore it pays higher or lower rates depending on the risk characteristics. But my point was simply that the market is reasonably efficient and will get these rates to come close together given that they have similar risk characteristics. Now, from your perspective, right, if you're in the 30% tax bracket, you'd be indifferent, right? But if you're in the 15% tax bracket, you wouldn't be indifferent. You'd rather have a 10% rate of return, pay 15% in tax, and have 85 left over. So you take 85 over 8.5% over 7% any day of the week if you're in the 15% tax bracket. Is that?
Yes.
Am I to answer your question?
Yes.
Okay.
Are municipal bonds usually less risky than corporate bonds?
Are municipal bonds usually less risky? And the answer is, well, historically they've been a little bit less risky, but recently there have been a few municipalities that in fact have done really stupid things. And so the risk inherent in municipal bonds has increased, at least the perception of risk has increased, at least in some locations, some localities. And all stupid things seem to happen in California for some reason. I'm sure it's a random event, though.
That's not a question. Does the term tax managed mutual fund mean something everyone?
What does tax, good question, what's a tax managed mutual fund? What is that? What does that mean?
They try and offset their capital gains with losses, so you don't.
See, one thing is they try to offset capital gains and capital losses, and therefore the net to you as an investor will be smaller. Right? That's one thing they do. What's another thing they do?
What does that mean, offset capital gains with losses?
Well, if you're one stock, stock 1, that has a gain of 100, right? And you sell a different stock, stock 2, has a loss of 101, right? The net effect is a loss of $1. If you only sold the first stock, you have to distribute that $100 to your stockholders, to your mutual fund holders. And so you try to offset gains and losses in a given year. You sell the bad with the good. Now, another thing that has to do with tax managed has to do with turnover. So here's the question. What does the turnover have to do with anything that has to do with taxes? What is the turnover in a mutual fund?
How often that they turn over stocks?
It's how often they sell stocks. Exactly right. So if the turnover is 400%, what does that tell you?
Pay lots of dividends.
No. The turnover is 400%. What does that tell you?
They sell the value of the portfolio.
They're buying and selling stocks on a regular basis. And therefore, and this is something we haven't talked about, if they are turning things over, if they're selling every stock or buying on a stock 4 times a year, right, what happens to their capital gain status? Now what we didn't talk about is the capital gain, CG, can either be short-term or long-term. And if it's a short-term capital gain, then it's taxed at ordinary income tax rates. If it's a long-term, then it's at the capital gain rate, which is 20%. Now, a long-term is how long? 1 year or more, right? So if a municipal fund has a turnover of 400, it's likely that they're going to have a large number of short-term capital gains, which means it's going to accrue to you as short-term capital gains, which means you're paying ordinary income tax rates on them, as if you receive dividends. Does that make sense? So, tax managed means a lot of things, and this is only 2 of them. But what it means is that if it's tax managed in a good way, the turnover is say 0.4 rather than 400, right? And what that means is that many of the gains are going to be long-term gains, and therefore going to be taxed at a much lower rate to you, the mutual fund holder. Does that make sense? Okay. Questions about that?
Yeah, why is it so good to offset your capital gains with capital losses?
So you don't pay taxes. For instance, one strategy that you might try right now is sell what you have and buy it back in a week or 10 days, right? Because most of what I have is going to be a capital loss. So if I sell it now, I recognize that capital loss, which gives me good tax benefits. The transactions cost to buy and sell now is very small, and then when the stock prices go up, it'll all be capital gain income down the road, and I get that juicy tax loss now that offsets other potential gains. Does that make sense? Okay. Anyway, so much for the current events. One more current event item, if I can find it. Because it's basically an accounting-related item. And I am on the first page of Section 3, which is the money and investing section. And here we have various stock indices. This particular stock index right here is called the Dow. Now here's my question. How do you get the Dow? How's that calculated?
20 or 30 industrial stocks.
20 or 30, that's what, okay, so it's 30 stocks, say. And I don't know the exact number, I think 30 is about right. What do you do with 30 stocks?
Add the values or stock.
All you do is add the prices. And it's as simple as that. Now, it turns out to be a little more complicated because, if a stock has a stock split, then suddenly you're adding, for stock A you're adding twice the value, for stock B you're adding 1/3 the value, but the basic idea is very simple. The Dow was simply we just add price of 1 plus the price of 2, and so if the Dow went up, that means that in aggregate total prices went up by a little bit. If the Dow went down, prices in aggregate went down a little bit. As simple as that. Questions? No magic there, right? There's very little magic in accounting.
Are the stocks used in the Dow like the same every time? Like the same 30 stocks are always tracked in the Dow?
Generally speaking, they will change. It will change periodically, but day in day out, any given year, it's likely the same stocks. Yeah.
How did they come up with the term blue chips?
Blue chip are simply the stocks that are considered to be relatively less risky.
Why are blue chips? Is that really easy?
I think it has to do with Big Blue. IBM was less risky. I honestly don't have any idea.
How do they come with 11,000 as the figure? Like you add 30 stocks and the share price of each stock are like, the Dow is 10,000 points. Like, what does it mean? Like, price of stock 1 plus stock 2 plus stock 3.
Now remember, if it was IBM, right, and IBM's been in the Dow for as long as, let's say it's been in forever, and IBM has had 10 stock splits along the way, right? You need to count the price of IBM 10 or 20 times in the Dow because of all the stock splits. So they have to be adjusted for what has happened over the past. It's not just, it's from some baseline forward, and you adjust for stock splits and stock dividends and blah, 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 stuff like that. But unless you understand the accounting, you don't understand what stock splits and stock dividends are. And that's the whole point there. Okay. Where did we end last time? We're transitioning into doing managerial accounting work. We ended with leverage. In particular, financial leverage. Now, we also went through an example where we forget the cost of capital. Often called the weighted average cost of capital. And you're going to see a lot more of that in a finance course. Now, the weighted average cost of capital, again, stuff we talked about last time, is comprised of two parts. One is the cost of liability plus the cost of equity. Now, suppose the cost of capital is 10%. And the firm uses that cost of capital to evaluate projects. Now, let's say that the cost of liabilities is 5%, the cost of equity is 15%, and it's 50-50. That gives us a cost of capital of 10%, true or false? Let me say that again. If the cost of debt, interest cost is 5%. This is after tax. And the cost of equity is 15%. In essence, after tax. And we get half of our cash from equity, half of our cash from liabilities. Then the weighted average cost of capital is going to be 1/2 of 15% plus 1/2 of 5%, or 10% total. True or false? True. That's the answer to that question, right? That's what the cost of capital is. Now, the next true or false is a little bit trickier. Suppose we accept a project that has a 10% return, which we should do because our hurdle rate is 10%. Anything 10% above will give us an acceptable project using the internal rate of return. Now, a 10% project will give a 15% rate of return to stockholders. True or false? Let me say that again. If I go out as a company and I accept a project that gives me a 10% rate of return, that 10% rate of return then will give our investors, our equity holders, a 15% rate of return. True or false?
False. Taxes and things that happen before you get
These are the after-tax numbers.
10% rate of return. You have more net income and pay more tax.
True or false?
Depends on what the stock price does and what you do with dividends.
Well, again, this is just the rate of return that goes to the investor before the investor's taxes are considered. Right? And the answer is
True.
true. That's the whole point behind leverage. What happens is you can get a relatively smaller rate of return on the project. You lever it up because of the amount of debt. One way to think about it goes like this. We have a 10% rate of return, right? Now, what are we paying our liability holders? We're paying them only 5%. So that portion of the amount, that 5%, goes to the equity holders. So the equity holders are going to get a 10 plus 5% rate of return, or 15%. Why? Primarily because the debt holders get such a small rate of return after tax. Does that make sense, everybody? And that's the whole point behind leverage, right? The whole point behind leverage is that you can accept a lower yielding project, but because you use debt, it can give a higher yield, higher than the return on the project, to your investors, because the cost of getting all the other money was so cheap. And all that return gets thrown off, that the liability holders are not getting, gets thrown off to the equity holders. Does that make sense? Again, I'm cutting the grass of a good finance teacher, but financial intuition and accounting, I think, are very important, because all of this stuff comes out of the accounting. Because liabilities and equity is just the right side of the balance sheet, right? It's just assets equal liabilities plus equity. So that's what, the right side is what financing is all about. Questions? I'm in chapter 31. Chapter 31. I want to do a little bit of background on the essence of managerial accounting and what we're trying to get a look at. And the picture at the bottom of the page is something we've been talking about a little bit with taxes. It's called life at the margin. If we have dollars per unit on the vertical and we have units on the horizontal, we have some price in the market, some price P, nice horizontal line. That means we don't affect the price. And we have a curve down here called the marginal cost curve. So the first question is, what is the marginal cost curve? And the marginal cost curve is simply the extra cost. Marginal means extra, right? So it's the extra cost to produce one extra unit. And notice what's happening to the marginal cost. The first unit costs a relatively small amount. The second unit costs a little bit more. Third unit costs more. Fourth unit costs more. And the costs in general are increasing as we increase output in this particular picture. Does that make sense to everybody? Now, the whole point behind managerial accounting and the question, how much does it cost, is to get a good look at what the marginal cost is. Now, it turns out accounting firms do not do a great job of figuring out the extra cost. Accounting firms do a great job of figuring out the average cost, but not the extra cost. But what we really want to get at is, what is the extra cost? That's what we'd like to see, but the problem is accounting firms don't do a good job of doing that. Now, given that we could figure out the marginal cost, the next question is, what is the optimum quantity to produce, and why? What's the optimum quantity to produce, and why? Does that make sense? Given the fact that quantity is increasing, cost is going up over time, what's the optimal amount to produce?
At the intersection?
Okay, the optimal amount to produce is at the intersection of the extra value, in this case the price, and the extra cost. In economics, that's where the marginal cost, this thing right here, is equal to the marginal revenue or the marginal benefit, right? Because the price is the good stuff, right? That's what we get when we sell this. That's the good stuff, right? So the optimum, which we often call Q star if you've ever had an economics class, comes at the intersection between marginal cost and the marginal revenue or marginal benefit curve. Now the question is, why do we do there? What are we maximizing if we stop there? For instance, why didn't we stop here at some quantity Q prime? Because pretty obviously the price is above the cost, therefore our profit would be higher if we stopped at Q prime. True or false?
Per unit, yes.
Okay, and so the issue you need to keep in mind is, are you trying to maximize profit per unit or total profits?
Overall profit.
And the answer is, in economics we try to maximize total profits. And so we continue to produce as long as the extra benefit is greater than the extra cost. So as long as the extra benefit is above the extra cost, we continue to produce these goods up to the point where the extra benefit is equal to the extra cost. And that way we capture this whole funnel right here, which in essence is in a sense, the profit funnel. Does that make sense to everybody? And again, the goal is to maximize what? Maximize total profits, not profit per unit. Questions? Okay. Next idea is the idea of opportunity cost. I am on page 31 too. The idea of an opportunity cost. So the example one, so suppose we have an individual who is a university professor making 50 grand. And they decide they're sick and tired of working for the university. And they go out and they start their own firm. And their revenues are 210. Their expenses are 170. And therefore their profit is 40. And so the question is, from a comparative perspective, is the individual better off or worse off? Now the way we do that is to ask the question, what is the opportunity cost of taking a new job? Right? And if we include all the costs of taking a new job, we have to include the cost, the amount of income given up. So we include the salary at 50, right? We pull that out, and the net then is what? There's a net economic benefit of negative $10 in this particular example. Because once we include the opportunity cost, suddenly this individual has obviously made a relatively not great economic move. Now there's something to be said for being your own boss and all kinds of stuff like that, right? But again, strictly on the dollars, once you include the opportunity cost, it's a bad idea. Does that make sense? Now, opportunity cost may sound like a fairly esoteric thing. It turns out to be very important anytime you're making decisions. I mean, for instance, those of you who are here tonight, you're incurring an opportunity cost. What's the opportunity cost?
Tuition. Free time.
Free time. Right? You are investing in human capital at a huge cost to you because you're paying tuition and you're giving up your time. Right? The tuition is the overt cost or the cash cost. But the opportunity cost is the fact that you could be someplace else, either learning more, having more fun, or earning some kind of a revenue. Does that make sense? And so there's this opportunity cost idea. I'll give you another example. When people come into MBAs, those of you who are married, does anybody ever tell you that a significant portion of people who start their MBA married leave single? Which turns out to be a truly high cost for many couples that didn't consider that as a possibility going in. Now that opportunity cost, hard to put a number value on it, right? But a very real cost that needs to be addressed in these kinds of decisions. Is that making sense? Okay. So Bob's point is that even though opportunity cost may seem like trivial, it turns out to have a big impact on people when they're making decisions. Next. I am talking next about sunk costs. I'm on page 31-5. Page 31-5. And here is the situation. We have a project that has an initial cost of $1.8 million. That in the first year, year one, brings in $1 million. Therefore, is recognized as this is not good, right? We have a negative $800,000 for the first year. But then we have years 2 and 3. This is project A. At the beginning of year 2, we have the alternative of moving to project B. Now, if we stay with A, we get $500,000 in the second year. That's the cash in. The cash out is $200,000. In year 3, it's $500,000 in, $200,000 out. Now we put a total out here. The total is $2 million coming in and $2.2 million going out. Turns out they're a real dog of a project, right? Negative $200,000 is this project. Project B, on the other hand, has cash in of $600,000, cash out of $300,000 for a net of $300,000. And in year 2 has a cash in of $300,000, cash out of $100,000 for a net cash flow of $200,000. We total this up in our total column. This is $900,000 cash in, $400,000 cash out, net benefit of $500,000. Does that make sense to everybody? And you have it all written down for you, right, in the notes. I just wanted to make sure you understood the numbers. Now here's the question. We're at the beginning of year 2. And you need to make a decision as manager. Do I continue on with project A, or do I move to project B?
Stay with it.
And the answer is, you stay with project A. Why?
Because you already lost the 800.
Loss is 200 only.
The first thing is that anything that happened in the past is called what? A sunk cost. And what that means is it does not affect the decision from this point forward. The decision from this point forward is going to be compare the what to the what? Compare the marginal cost versus the marginal benefit, right? The benefits are the cash in, the cost is the cash out. So, project 1, we have a net 300, a net 300 here, for a total of 600. Net cash in from the beginning of year 2 on. For this project here, we have 300 here, 200 here, or 500 total over the 2 years. So the question becomes, would you rather have 600 or 500? I'll take 6. Thank you very much. Does that make sense? But again, the decision making was what? We compare the extra cost to the extra benefit from this point forward. That's how we made that decision. Right? Now, that's where we started with this analysis. When we brought in this picture here, because we're comparing the extra cost with the extra benefit. And as long as the extra benefit were greater than the extra cost, we did that, we added one more, we produced one more unit. As soon as the extra cost got above Q double prime, the extra benefit, what did we do? We refused to take on that project, we refused to produce in that range. But again, the key is to be able to compare the extra cost with the extra benefit. And the point being that in economics, it's a very sound way to make decisions. In accounting, it's very difficult to understand what the extra cost actually is. Because accounting systems aren't designed to look at the marginal analysis. Questions? And I'll only bore you with a couple more examples here. When you think about it, wouldn't these examples make great final exam questions? Short and sweet, problem solving, easy to grade, no essays that you have to read, right? Man, these look like good exam questions to me. I don't know. Special orders. I'm on page 31.6, example 7, in case your page is a little bit different. So, example 7. We have a firm that's constant variable cost and receives an order for 25,000 units. The firm is operating in the relevant range so that fixed costs would not change. Now, what does that mean? It means fixed costs are held fixed over this production range. That's all that means. They don't have to build a new building to continue on to produce another 25,000 units. Now, the average cost per unit at a production level of 100,000 units is $20 per unit, and the average cost at a production level of 200,000 units is $15 per unit. Let me draw that for you, just to make sure that makes sense. So if we look at dollars per unit on the vertical, and we look at units on the horizontal, what's going on is, here, this is 20, this is 15, so at 10,000 units, we're up here. At 20,000 units, we're down here. And so what we have is a curve, looks like that. Now what curve is this? What's this called?
Total cost.
The average total cost curve. That's right. And it's the average total cost, total being what? That includes two types of costs. What are those two types of costs again?
Fixed and variable.
Fixed and variable. Question. Now, why is this average total cost curve declining? Why is the average total cost curve declining?
Because fixed cost is going down per unit.
Fixed cost per unit is declining, right? Does that make sense to everybody? And so in this case, currently they're producing how many units? They're producing 150,000 units, so currently they are about right here, right? And therefore their cost to produce is about how much? Again, roughly estimated, call it 17, between 17 and 18 is their cost right now. So someone comes in and they want to buy 25,000 units, but the price they're offering is $14 per unit. Do you accept that bid and sell 25,000 more units to that customer when your cost is 17, give or take? Again, what's the key? What are you trying to analyze? What's the key to this analysis? You're comparing the what?
Marginal benefits to marginal cost.
The extra benefits to the extra cost. Exactly right. What's the extra cost to produce these items?
16.
Okay, what's the extra cost? Do the fixed costs change as we increase the number of units? The answer is no. The fixed costs are fixed, right? The average fixed cost comes down, but total fixed cost remains the same, right? So in order to get the extra cost, we have to ignore the fixed cost. Does that make sense? How do we do that? Well, in this particular example, we look at the cost at 20,000 units, which would be $20 per share times the 10,000 units, giving us $2 million in cost to produce that many units. We come down here to 15. excuse me, this is, yeah. And so it's $15, produces 20,000 units, that gives us 3 million. And so what do we have? The extra cost, the change in cost is equal to what? $1 million, right? We went from 2 million up to 3 million when we produced from 10,000 to 20,000 units, right? Everyone with me? And the change in units is how much?
100,000. 10,000.
10,000 I did, it should be 100 in the example, you're right. So in the example, it's actually 200. It's actually 100, right? I'm sorry about that. And so what we do then is we could look at the extra units compared to the extra cost, and that gives us our marginal cost, which is the extra units, the extra cost, which is 1 million, divided by the extra units, 100,000, gives us the cost of what? $10 per unit. Someone joking out there with us. It'll be okay. Does that make sense? So our goal was to try to figure out what is the extra cost. And the extra cost in this example is, you look at the extra cost to produce extra units, compare that to the extra units, you get in a sense, the average of the extra costs. But you get some sense of what it costs you to produce at the margin. You compare that to the amount that they're going to receive, which is 14. Now, should they sell those 25,000 units at a price of 14 when their extra cost is 10? And the answer is yes. At least in the short run. I mean, does it make sense to you financially? And the answer is yes, providing that the people they sell to at 14 never ever interact with their current customers, right? Because if their average cost is say 17, their price in the market is probably more like 25. But if the price in the market comes down to 14 and their cost is 15, they're screwed. Does that make sense to everybody? Okay. Questions about that?
So have you in effect subtracted out fixed costs?
In a sense, we have ignored the fixed costs because they don't change as we increase volume, right? And if we're comparing the extra cost to the extra unit, fixed cost doesn't change. The lease stayed the same, right? Questions? Okay, let's take a short break right here. I'd like to get going as soon as we can. So it's 7:46 on our clock. We'll try for a 5-minute break and get back here, between 5 and 10 days.